Hello viewers, my name is Cameron Clatterbuck and today I'm going to talk about mutual funds. As we all know, for this project we had to analyze two different mutual funds in each of the following industries: domestic, international, and sector. The categories I will be analyzing for my comparisons are turnover, expenses, performance, and management. For my domestic mutual funds, I will be taking a look at the comparisons between Fidelity's Blue Chip Growth Fund and JP Morgan's Intrepid Growth Fund, which you will see right here in the blue. To provide a brief history of these funds, Fidelity's has been around since 1987 and its portfolio manager, Sanu Kalra, has had tenure for almost a decade now. In the other corner, JP Morgan's fund has been around since 2005 and a manager with the longest tenure, Jason Alonso, has conducted overwatch on this portfolio since its inception. Without looking ahead at the data, we have a positive for each fund. Fidelity's has been around nearly 18 years longer, and JP Morgan's has had the same person looking it over for a longer time period than Fidelity's manager. Looking at the turnover ratios for these funds will help us to predict future returns. As we learned in class, as well as through my backtesting and investment strategy video, a lower turnover ratio is conducive to higher returns. Now we see that Fidelity has a 43% turnover ratio and JP Morgan has a 69% turnover ratio. If we look ahead at their one-year returns, we can see that Fidelity does indeed have a higher return of 41 basis points between these two. This trend carries on to the 3-year returns, as it is noticed that Fidelity has a 74 basis point lead in difference between these two funds. Another thing we learned in class was that a lower expense ratio usually comes with higher returns. If we backtrack to the expense ratios, we can see that Fidelity's is 0.72 and JP Morgan's is 0.84. Since we have already analyzed our returns, we know that Fidelity has the higher returns, thus proving that a lower expense ratio really is indicative of better performance. Another interesting aspect to analyze regarding these mutual funds is the dividends that they pay. Fidelity pays a 7-cent dividend, while JP Morgan does not pay one at all. And you see those two right here. What this means is that currently Fidelity's fund probably has more equity to it, while JP Morgan's fund has fewer stocks and or ETFs that pay a dividend. Lastly, there is beta. The balance.com refers to beta as a way to measure a fund's volatility as compared to a benchmark, usually a specific index. For example, if a fund's best fit data, beta, as Morningstar would call it, is 1.20, then this tells the investors that they can expect the fund to have a return approximately 20% higher than the benchmark in an up market and approximately 20% lower in a down market. This is almost like the lesson we learned about how leverage can magnify both gains and losses. We see that Fidelity's fund has a beta of 1.22 and JP Morgan's fund has a beta of 1.15. In the last few months, we have witnessed a down market, and therefore JP Morgan's fund was predicted to be closer to a stagnant return, which would be good in this case. Sure enough, when I checked the numbers, I saw that Fidelity's fund is down 5.1% over the last 3 months, while JP Morgan's is only down 4.2%. Now, moving on to international funds, right here in the yellow, I will be comparing Vanguard's International Growth Fund and Morgan Stanley's International Opportunity Fund. Vanguard's fund has been around since 1981, so actually earlier than the Fidelity fund I mentioned in the previous section, and the Morgan Stanley fund has been around since 2010. Vanguard's lead manager, James Anderson, has been in charge since 2003, and Morgan Stanley's lead manager, Kristen Hugh, has been in charge since the fund's inception. Therefore, good experience exists with both funds. Looking at the turnover ratios, we can see that Vanguard's fund is at 16% and Morgan Stanley's fund is at 30%. Now, what's different between these international funds and the domestic funds is that we see that the fund with the lower turnover ratio here, which is Vanguard, actually has the lower return, as opposed to having the higher return, which would have been the norm. This trend continues from 1-year returns to the 3-year returns, as you guys can see here. Looking at the expense ratios, we see the same concept. Vanguard's expense ratio is 0.45, and Morgan Stanley's expense ratio is 1.29. And of course, Vanguard has the lower return as opposed to the higher one, which would have been the norm. As we saw in the domestic funds, one fund, Vanguard, provides a dividend to investors, and Morgan Stanley does not. However, what does make sense throughout this, though, is the betas. Vanguard has a beta of 1.13, and Morgan Stanley has a beta of 1.02. Since we are coming out of a down market, hopefully that is, Vanguard should have the lower returns, and they do. Lastly, there are the sector funds. In this last segment, I will be comparing Fidelity's Select Healthcare Fund and Vanguard's Healthcare Index Fund. Fidelity's has been around since 1986. However, its lead manager, Justin Segalini, has been overlooking the portfolio only since 2016. Vanguard's has been around since 2004, with its lead manager, Michelle Louis, only being in charge for 1 year. With such new managers, it will be interesting to see how the funds will perform in the future. These funds seem to be following the trends of the international funds. Fidelity's turnover ratio is 65%, and Vanguard's turnover is only 6%. Looking at the 1 and 3 year returns, we can see that Fidelity's fund has the higher returns. As said earlier, the trend continues with expense ratios. Fidelity's is 0.77%, and Vanguard's is 0.1%. And of course, the higher return goes to Fidelity. Something new here is that neither of these funds provide investors with dividends. And lastly, both of these betas are 1 or close to 1, so they will mirror the index. And that concludes my research on mutual funds. Thank you for watching.